we do believe that interest rates will remain consistent or drop, as you mentioned. But we also believe that there's going to be pressure on interest rates in 27, 28, and 29. And so that means you really need to think about the debt that you're going to be putting on assets and the capital stack that you're looking at for properties that you're acquiring today or financing today, because pressure on interest rates, we believe, will grow, and that, there may be a change in what's going to happen with interest rates, as I mentioned, in not in 26, not potentially in 27, but there is the potential for 28, 29, 30, 31, 32. We look at a very long horizon.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast YouTube series, Real Estate Market Watch, Current Events Through a Real Estate Lens. My guest today is Jeffrey Rosenberg, Chairman and CEO of Big V Property Group. Big V is a sponsor that specializes in open air shopping centers in high growth demographic areas, markets, especially discount oriented power centers. In 2025, the group successfully closed the largest financing or debt refinancing in the country for retail. And Jeff talks a little bit about that. He also discusses the trends for retail, why they are becoming of increased interest to investors, both institutional and individual, and what the effect that is happening on his company's ability to deliver the same kinds of rates or returns that they have been historically. Jeff and I also talk about trends on the equity side, what kind of capital is looking at retail and how the pricing of that capital is evolving as the economy changes. One final thing. Towards the end of our conversation, we discuss interest rates, and Jeff's perspective on where interest rates are headed is exactly the same as mine. I won't give it away now, but stick around until the end of the podcast and you find out where we're headed. It is very, very prudent. And if you can talk in hindsight ahead, right, it's very prescient as well, in my view. So anyway, stick around for that. If you're an investor, it doesn't matter, investor or sponsor, those insights are going to be ones that you want to be taking note of and underwriting and preparing for sure. Okay. If we are not connected on LinkedIn, go ahead and connect with me on LinkedIn. You find me Gower Crowd at Gower Crowd, or you just look up my name, Adam Gower. I'm writing a lot on LinkedIn at the moment. It's a great place to meet people. It's like, I think of it as like not social media, but business casual media. So it's a great place to meet and say hello to some very bright people and share ideas and actually learn a lot about what's going on in the industry. All right. So if you've got a chance, go ahead over there to LinkedIn and connect with me if we are not already connected. Okay. Without further ado, let's move on. Jeff Rosenberg, Chairman and CEO, Big V Property Group, coming right up. Jeff, nice to meet you. Thanks so much for joining me on the podcast today. You are an open air shopping center wizard. Why do you like open air shopping centers? Tell me, what's it all about open air shopping centers?
Well, first of all, thank you for calling me a wizard. But it takes a village or a small town to become a wizard. And so my definition of luck, right? Some people say when you're investing in retail and open air centers at a time when it's in high demand, it's pretty lucky. But there's nothing lucky about it, right? My definition of luck has always been when preparation meets opportunity. And so we're prepared and there was an opportunity and we were able to take advantage of it. But we started in the open air center business in the 40s when my grandfather started building supermarkets. And we owned the supermarkets and the shopping centers associated with them. And then we sold the operating company the supermarket operating company in the late 80s and transitioned to open air centers around the country, from that period to today.
And so, what are the economics of an open air shopping center? What are the challenges and the opportunities that you see? Actually, let's just start with the challenges, right? Because retail has had a bad rap, but I know it's coming around. So, talk about that
It
challenges.
has. And so, we believe that retail actually went through its own, earlier period of time when it had significant challenges. You have to remember during COVID, everybody thought retail will fail. Even earlier, we had issues with the internet and everybody assuming
Mhm.
that, retail is going to go away because you could order everything online. We know today that that's not correct. We know today that people like to touch, feel, travel, buy, socialize, and look at the product that they're buying. And we also know today that the successful retailers have become really omnidirectional delivery systems, right? So the successful retailer today is delivering product how the consumer wants it, how their customer wants it, whether that's in store, pickup, shipping, um, sidewalk or drive up. There's all sorts of delivery systems. And I think most retailers today have determined that the best warehouse is their own store, and the cheapest warehouse is their own
Hmm.
store locations, and their own. They've turned them into multi, as I said, omni-directional like fulfillment systems.
Really? Is that's something I've thought about actually, but you just articulated it. And that is that large boxes use their stores as warehouses for
Yeah.
distribution of all kinds.
Yeah,
Really?
very much so. And so,
Hmm.
what does that mean for the warehouse, retail side of
Right.
or the
Industrial,
warehouse
right? Yeah.
industrial business? That you have to ask yourself that. But today, retailers are retailers anyway. A lot of our retailers and major tenants in our shopping centers use their stores in various other ways than just being a retail. But some interesting facts, right? If
Hmm.
you open a new store in a new market, you're going to drive about 30% more traffic to your website from that store and that store location and visibility. If you close a store in a market, you're going to lose approximately a similar amount of traffic to your website. And so stores become a opportunity to remind consumers of the products that you sell as they drive by, look at, or see your location in a specific market.
That's fascinating. That's because consumers will pick up their phones or whatever device. They'll search for something, or they might just like, what has the local store got for me? And that's what drives the traffic.
Yeah, so part of that drives the traffic, the visibility of the store itself, and a reminder that, there's an opportunity to either order online, look at what's in the store, and evaluate what you might need as a consumer that you desire at that point in time.
So, what other kinds of distribution might a store? I mean, if you can give specific examples, if you can, would be
Sure. Well, I
interesting. But
mean,
yeah.
distribution. So the easiest one today is sort of Target, right? So
Mhm.
Target, when you can order on uh, the Target app, drive into a parking space in front of the store, and I think their time limit is 3 minutes to come out and put it in your trunk.
Mhm.
You can order online, go into the store and pick it up. You can order online and have it shipped to you, within a day. So I think Target says that they're 1 day shipping within 95% of the country. And so, because of where their stores are located, and you can go in the store, have it shipped to you. You can go in the store, pick it up. And so, there are all sorts of various types of delivery systems that a store like Target provides to their customers, depending upon what the customer wants.
And any kind of larger scale distribution as well. Like when you think of an industrial warehouse, you think of pallets. When you
Yes.
think of Target, you think of a t-shirt, right? Or whatever.
Right, that's right. And I don't know, I don't know that for a fact. So I've never really looked at whether they're doing pallets of dry goods or pallets of other types of products on a larger scale basis. Our experience has always been on the one-offs for
Mm.
them. And maybe larger scale is going through a industrial site or a warehouse site. Maybe Best Buy is another uh,
Hmm.
good company that has mastered the omnidirectional delivery system for their customers. And so it's kind of interesting. One of the Best Buys that we have in one of our shopping centers, I go in there, this was last year, and the store looked pretty, the shelves looked a little empty. So I asked the store manager what's going on. He says, well, we get shipments almost constantly, but the consumer demand is so high for a pickup that we can't, we're struggling a little bit in keeping our shelves filled, not because we don't have the demand, but because we can't get the product fast enough. And so I thought that was an interesting. Now that may have been just a moment in time, right, during with delivery systems, but I thought that was an interesting perspective because sometimes you go into a store and you say, "Wow, these shelves look pretty empty." Well,
Mm.
they may not be empty because there's no demand. They may be empty because there's too much demand.
Okay, so off topic, but it reminds me once I went to a friend's house for dinner and he pulled out a bottle of scotch and there was just, a couple of fingers left at the bottom. And he said, sorry, he said he brought it out and he apologized. He said, sorry, we never drink this stuff. And I looked at the empty bottle and I said, what do you mean you empty, brought out
Sure.
an empty bottle? Of course you drink it. Um, all right, so, but your focus also is on, especially on discount oriented power centers. Is that correct?
Yes, correct. And so
Mm.
we typically like centers that are anchored by a Target, and then
Ah.
our preferred tenants are Ross Stores, TJ Maxx, HomeGoods, Sierra Trading, those types of discount operators. And they've been very successful over the
Mm.
last, 10, 15, 20 years, and they drive traffic to our centers. But it's interesting because it used to be when my grandfather used to open up a supermarket, he would just drive around with my grandmother and say, "Hey, there's a lot of houses here. Let's open up a supermarket." Well, we no longer, do that type of market research on an individual basis.
Mm.
We do that market research in terms of when we look to acquire property.
Mm.
We look at the number of houses around, the demand, the traffic, how that compares to other shopping centers within the area, other shopping centers within the market, and we sort of gauge the accessibility and the popularity of a center.
Okay, so that's interesting. So you do so you find a center that has a target in it. Um,
Hmm.
and so then to what extent does Target help you understand what the demographics are, what their foot traffic is like, or their revenue per square foot that helps you understand the market as well? It seems like you're doubling the work. If a target is there, isn't by definition it the right place for a target?
By definition, Target's done a lot of work and put a
Right.
lot of people, right? Target owns almost all of their stores. There are very few leased Targets, and so we
Hmm.
actually have a Target under construction today. We own a shopping center in Wilmington, North Carolina, and we had a big empty space, and we ended up selling that to Target, and Target's under construction with their own store today. Target does do a lot of the work for the other retailers. They look at the markets, they look at the demographics, they look at the growth, they look at the long-term potential drivers of business in that area, and then make a decision to put a store in. And then they carry with them other potential retailers for the traffic that's driven to the shopping center. You have to remember when you put a big box retailer in a center, you're not only enhancing the quality of the center, but you're also providing amenities to the other tenants. And so, entrances need to be widened, visibility needs to be increased. You need to work with the municipality in order to put turn lanes in. And so there's all sorts of things that need to be done when you negotiate and add a big box retailer to your shopping center.
Yeah, I used to develop large scale multiplex movie theaters. for Universal Studios in Asia Pacific, like most people do,
Wow.
in their careers.
Of course. I mean, Asia Pacific, why wouldn't you? I mean,
Bringing culture to the masses. What can I tell
there
you?
you go.
Anyway,
Yeah.
we built these theaters, and parking was a huge deal as well. I mean, all these things that you've talked about was major. Ingress and egress was major. All right, Jeff. So, but what would you say are the challenges and opportunities? Let's look at that going into 26
Okay.
for your asset class.
So there are the challenge has become that retail is a desired asset class for people to invest in. And so what does that mean for us as a owner operator? It means that pricing is getting more aggressive for the assets themselves. It makes it harder for us to acquire the assets because there are more people bidding for them. And it also means that different capital is coming into our market. So it used to be that, specialists like ourselves, we're the only folks buying retail or open air centers, and we were competing against other individuals similar to ourselves. But today, we're competing against other users, industrial users who are repurposing capital and putting them into open air centers because we continue to have a risk adjusted return which is more accretive than some of the other asset classes. And so today, a return that we expect from our purchases, risk adjusted, is lower than what we've gotten in the past, but it's still a good IRR for our capital. It's still, 10, 11, 12, 13, 14 IRR on invested capital for the retail shopping centers, but uh, there's more capital coming into this market. It's gotten more aggressive, and there's always risk related to the asset itself, and so you need to make a informed decision on the asset that you're purchasing because while our industry is at an all-time high for occupancy, so I think across the board, we on the retail open air center side is approximately 90, I think it was 96 or 97% on average occupancy, right? And so vacancy factors are very low in our business, but that doesn't mean there isn't vacancy, and there's reasons there's vacancy, right? During COVID, people took their fleets and they economized and enhanced the quality of their fleet by removing stores that were tertiary, secondary, or low performing stores. And you saw sort of a pruning of the store fleet of various retailers as they looked at opportunities around the country, and that means that if you bought an asset, and we have several of these, if you bought an asset where it was in a secondary market, not on a main thoroughfare, and harder to get to, it's possible that your
So,
tenants move to a more central location. And we've had that happen on some of our earlier assets that we purchased, where the tenants have economized and moved their stores elsewhere to a more central location, which means that those assets have now gotten different tenants that pay lower rents, and so you'll have an impairment of value for those centers going forward.
Jeff, I want to ask a daft question. It's not a daft question, it's quite serious.
Sure.
If you are out in the market finding that it's difficult to buy at the kind of level that you want because the cost of capital is too high, returns are too low, prices are too high, does that not tell you it's the time to sell?
Yes and no. So we have been selling assets on a periodic basis as we look at opportunities in the market. So there is an opportunity to sell assets and there are opportunities, but we have assets that we have lots of opportunity to increase value over a period of time. And so we look at and we weigh that and we say, okay, there's a value today that we could harvest for ourselves and our investors. But, if we keep this asset another 6 years, we think we can grow our NOI X, which will then enhance the value across that period of time. We think occupancy will go up. We think we can enhance credit at the center and replace tenants with a higher credit tenant or multiple higher credit tenants. and then that will just reduce the cap rate, increase the value of the center. And so in 3 or 4 years, we get a different outcome than the outcome today. And the outcome today might be acceptable, but the outcome, 3 or 4 years from now might be phenomenal. And so we've done that with many
Mm.
of our centers because we have an asset management team and we are constantly
Mm.
evaluating the assets that we own and whether there's opportunity to continue to enhance value or whether there's an opportunity today to harvest that value that we've created over
Mm.
a period of time.
Okay, so in an ideal world, how would you describe your ideal time hold period? We talked about this briefly.
Well, yeah, so we've always told people that, we like to hold assets for as long as possible, but
Mm.
we are opportunistic on the buy side and we're opportunistic on the sell side. And so if we see there's an opportunity where we're going to harvest value and we think it's at the top, and today, there are centers that we own where we think that values will continue to go up, but they won't rise as fast as they have in the past. And so maybe there's an opportunity to recycle capital and put that capital in other opportunities in the future. And so we do look at that on an ongoing basis to really evaluate
Mm.
whether this asset is is going to continue to grow, or it for us, has reached the end of its hold period and we can recycle capital in an accretive way. We a couple of years ago, so for a firm our size, we have a market research group and led by an individual that we hired several years ago, and that we look at all sorts of variability with the assets that we own. And so we look at the quality of the tenants, we look at the what's going on with the market that we're in. Are we in the main of retail? Is retail moving away from the center that we own? A couple of years ago we traded out of a center, not because we didn't like the center, but because retail and the desirability of that location had moved away to a
Mm.
different pocket. And so we said, okay, well, is this a long-term hold or do we want to, recycle this capital because this market has moved away from where this shopping center is? And so we look at all of those pieces when we evaluate whether we're going to continue to hold an asset or not.
What causes retail to migrate?
Oh, it's population densities. It's a variety of various factors, and whether that's growth in the
Mm.
market, new development, new housing. We have decided to move into the development side of retail as well, because I'm sure you've shared or your listeners know, retail development has been at an all-time low for the last 20 years plus. And
Mm.
so, unlike multifamily, there's been very, very little new retail being built, which is accounts for the fact that, we have high occupancy. So if you think about, the cycles, right? Um,
Mm.
you've got the cycles where you build as demand increases, you build, you get to a point, demand is sated, then rents go down because now you're overbuilt into a period of time where then it continues to stabilize and then, the cycle returns. But retail has been fairly steady in that not, very, very little new retail has been built. And so we're under construction for a new shopping center in Texas where there's massive amounts of residential housing being built that's affordable. People are moving into the area and you're seeing growth. But, you know, resident so development is a function really of the rents that you can receive from the tenants and the land price. I mean, construction is fairly stable, right? So you know what construction costs are. And so the only two variables you can play with are land cost and potentially rents that tenants will pay. In the past, retail tenants haven't been willing to pay new construction rents in order because they just haven't been able to afford it. But we're seeing today
Mm.
that rents are being supported for new construction in certain areas around the country.
That's
right?
fascinating. And how do you figure that out? Is that something that you figure out through relationships that you have with major retailers? They help you identify, hey, we want to be in this location, or do you lead the charge to a location and take it to them?
Yeah, we do a little bit of both. I mean, I think you identify what markets are high growth. It really starts on the residential side, right? Where the residential development is growing, and that's what starts driving traffic to our to the opportunities that we see. And so first there's residential growth. Then, we look at the various opportunities within that residential growth area, and then we put that under contract and then look for partners to sign leases and develop the asset that we plan there.
We talked a little bit before we got started about how you capitalize your deals. If you don't want to talk about that now, just let me know. If there's anything I ask you at all, just say Adam Pound Sand and we'll move on, right?
Okay.
All right. But so how do you typically finance your deals? I'm interested in knowing what the trends are for capital actually at the
Right.
moment. Yeah.
Yeah, so in the beginning and today, it's friends and family, high net worth individuals, and family offices. And so we've financed almost all of our purchases in that way over the last, let's say, 10 years. But that capital is expensive. And so today we're looking at other ways to finance our growth. One is institutional. And so we are partnering with very institutional capital providers in order to acquire new assets within the marketplace. And then there are other opportunities that we're looking at for various ways to finance our business. But when we do high net worth individuals, the capital stack is usually you start off with a primary lender that's 60 or 65. Back in the day, 10, 15 years ago, you can actually get 75% leverage on a purchase. But as you know, today at 60 or 65 is max that a primary lender will allow you to go up to. So then the difference between 60 or 65 and 85%, we've been using mezz or pref equity for that piece. And then you've got the equity, our high net worth individuals and family offices equity that's above that. And that's how we've been filling the capital stack over the last couple of years.
And what trends have you seen both on the debt and the equity side in the last couple of years? Been very interesting last couple of years because interest rates have spiked. So yeah, what have you been seeing in the retail world?
Well, for retail, for a period of time, it was hard to get any financing whatsoever, right? Because prior to COVID and then during COVID, there was a lot of variability, there was a lot of risk associated with retail, and so it was hard to actually interest banks to invest and lend on retail. That's changed today. Retail is highly desirable as an asset class. I think I shared we just did a
Hmm.
roll up where we took eight of our iconic larger properties, about $1.1 billion worth, and rolled them up into one fund and refinanced all of those assets. And so we did a loan with Truist, led by Truist Bank, US Bank, Regions, and Huntington Bank, and
Mhm.
we did a $765 million loan with those banks that's on balance sheet. So we didn't do CMBS, we didn't do
Hmm.
other types of loans. We did a basic on balance sheet bank loan for these assets, which was a great execution for us.
Yeah, and also you mentioned that was the largest retail loan for 25. Is that right?
Yep. Yep. That's what the banks tell us. It's the largest retail loan that Truist has ever done. And I'm
Hmm.
assuming some of the other banks that are part of that group as well. And so it was a great execution. These are assets that are truly unique in the marketplace. They're all high quality core assets, and
Hmm.
they're long-term holds for us.
Hmm. So yield plays basically. What kind of yield do investors get in a strictly core?
Cash on cash is in 6 to 7, and IRRs. It depends upon how the properties are going to perform over a period of time. But
Hmm.
I think the yields are comparable to what you might find better than what you might find in the public markets, and similar in some of the private markets with more stability. I mean, we took assets that are mostly in the South, that are in multiple states, combine them into one fund, and it
Mm.
gives you all sorts of opportunity there for, um, safety and, um, if one center has a problem, that's not going to affect other centers around the country. And so I think there's lots of
Mm.
opportunity there for us to continue to provide quality cash flows for our investors over a period of time with growth.
When you talk about IRR, that implies an exit at some point, but you've also talked about long term. So how do you balance these
That's
ideas?
a that one's a hard question because in this scenario with a roll up, we're not actually looking at an exit anytime in the future. And so in the past, many people have said, all right, the way we're going to keep this center is we're going to refinance it. We've gotten enough growth in order to return to refinance it for higher than the capital that we have currently invested, return some of the investors' capital and continue to hold on to it at an accretive return rate in the future. And so, there are opportunities with this fund in various ways for us uh, to provide returns to our investors in the future.
Do you pass through depreciation benefits as well to
Yes,
investors?
we do. Yep.
And you can do that in a fund as you do that in a fund as well.
You can. And then
Yeah.
there's an added benefit because in the past, most of the debt has been guaranteed by myself and my partners. And so we've taken the depreciation or the related to the debt, the amortization related to the debt. In the
Mm.
fund, everybody gets that opportunity. So
Mm.
in the fund, everybody is getting the debt amortization as part of, their K-1s that they receive on a yearly basis.
Yeah, and that's what makes a 6 or 7 look a lot better because,
That's
in
right.
fact, it's actually significantly higher
Yep.
in terms of gross returns, isn't it?
Yep. That's right.
Yeah. So, what trends have you seen? Okay, so family offices, friends and family
Mhm.
on the equity side. Um, what what trends are you seeing on the equity side in the last few years? We've had interest rates spike in multifamily world as I don't say imploded, but has had significant problems, a lot more so than the headlines suggest. There's lots under the surface that we don't see. Office obviously has had some struggles. So what kind of trends or sentiment do you find in your investor base?
I think our investors are cautious,
Mm.
but looking at the opportunity that we're providing, which is a good return for capital today. So retail, in general, has a stronger return than other asset classes and more consistent over a period of time. And so our investors are more cautious than in the past, but
Mm.
also still willing to invest in retail alongside us because everybody sees the opportunity. Retail's not going away. Big box retailers are not going away anytime soon. We'll always have ebbs and flows, but we do believe that the assets that were purchased are providing value to the communities that they operate within, and those values will remain over a long period of time. And so those values will remain and allow us to harvest future returns that are associated with the risks that we're taking. There are a couple of sayings I like. So during COVID, we were very aggressive in buying assets. Nobody, very few people were buying assets. We were buying assets, and there are a couple of Warren Buffett isms that I like that mostly relate to the stock market, but we use them on the real estate side. One of them, when you think it's raining gold, put out a bucket, not a thimble. And so we thought during COVID that retail was still here to stay, that it wasn't going away. And so we acquired as much as possible during that period of time. And the second is when people are fearful, be bold. And then when people are bold, be fearful. And so, in a similar scenario, we actually, took risks when other people were fearful, and that was to our benefit. Today, as we know, retail is still here, it's still strong, it's still growing, and still providing value services to the communities that we operate within.
Has the fear gone from retail then, do you think?
No, I still think there is some fear related to growth in online, related to demographic shifts, related to shopping habit shifts. But for the most part, I think it's an accepted institutional asset class today, whereas in the past it was not. And so I think you see a rebalancing of
Mm,
individual investors' portfolio where more people are interested in investing in retail today than they have been in the past.
mm. Okay, so we're at the top of the hour, Jeff. We've been going for quite a long time. But the podcast's only been about half an hour. But I'm going to go ahead and start moving to wrapping up. If you just got a few more minutes, you
Sure.
can stand with me. Yeah. Okay, so let's talk about 2026. Uh, so I'll share with you my views. I'd be interested to hear yours.
Okay.
Almost certainly, we're going to see downward pressure on interest rates, even the 10-year. One way or another, we're going to see downward pressure. We've got deregulation of banks as
Hmm.
back to pre 2008 levels. So we're going to see a lot more liquidity coming into the market. Incredible injection of tax incentives through the last bill. And my favorite right now is this buy low, sell high, right? You got a stock market that is at historic highs and a real estate market that is still in many by many views still bumping along bottom.
Hmm.
So sell high out of the stock market, divest into real estate. 26 is going to be a great year for real estate. What do you think?
I agree, but it's going to be a difficult year because all of those components that you mentioned means more capital is coming into the market than ever before. And
Mm,
more capital are chasing higher quality assets than ever before. And so we talked about this earlier. Is it a time to sell? Maybe, but is it a time to be able to acquire really good assets in the marketplace? Yes, we still believe that there are opportunities out there to acquire really strong, good quality assets, but it's becoming much more competitive in the marketplace than it ever has in the past. And so that means that for us, yields are going to go down, prices are going to go up, and it may be a little more expensive, and the returns that we are used to seeing will be less than we will see in 2026 than we've seen in prior years. And so it definitely is a challenge because of the interest that people have in retail real estate today.
mm. Okay, let me ask you one final question before we
Sure.
wrap up. All right, so what are the keys? So I rattled off four different reasons why there's going to be a rush of activity in real estate, right? So I think we're right at the beginning of that. I think you're right. It's going to push values up. In other words, price is going to make it harder and harder to buy. But if you get in early enough, you'll be able to catch that wave.
Hmm.
Provided you are very, very careful, because after that comes an inevitable downturn as well. I don't
Hmm.
That's right in terms of
Right.
retail. All right. So, what are the key signals you're watching for that inform you about where we are in the cycle, where the market is headed, and whether or not any of these assumptions or conditions that I've just described are actually manifesting?
Yeah, so we do believe that interest rates will remain consistent or drop, as you mentioned, but we also believe that there's going to be pressure on interest rates in 27, 28, and 29. And so that means you really need to think about the debt that you're going to be putting on assets and the capital stack that you're looking at for properties that you're acquiring today or financing today, because you know pressure on interest rates we believe, will grow, and that, there may be a change in what's going to happen with interest rates, as I mentioned, in not in 26, not potentially in 27, but there is the potential for 28, 29, 30, 31, 32. We look at a very long horizon, right? So when we acquire an asset, You're evaluating the asset for the opportunities that it has today, and then what happens in the future, because that's going to affect cap rates, the ability for you to exit out of the property, the ability for monetize the asset for your investors. And so we are looking at 31, 30, 32, 33, and what the market will be like at that point in time when we evaluate an asset. And, I think if you acquire an asset, the fundamentals are strong. The We do not compress cap rates on exits. And so we evaluate the opportunity of an asset with a non-compressed cap rate because you can't rely upon compressed cap rates in 29, 30, 31, or 32. You have to make an assumption that you may have NOI growth, through contract rents or through leasing or other opportunities, but you cannot rely upon any sort of cap rate compression. And in the past, 10, 15 years ago, we did a lot of that. We said, all right, we're going to buy this asset at a 7, and maybe we're going to sell it 5 years from now at a 6.85, right? So a little bit of cap rate compression, which helps the IRR and gets you, but we no longer look at assets that way. And I think if you stick with strong fundamentals, you're conservative in your underwriting, and you really don't look to compress cap rates in the future, and you make your decisions based upon those criteria. We believe you should be pretty safe in the marketplace in terms of purchases. But that then says that there are assets out there which we can't afford to buy because other people are compressing cap rates and other people are making decisions that on the capital stack, which we're conservative and we generally don't make.
Theirs will be properties you will buy in 32.
There will be. And there'll be properties we'll buy in 26, but we're
Right.
gonna, we play a very conservative, we're very conservative in our market. We have never lost our investors money ever in all of the years that we have been doing this. Now we've had, close to zero returns, but we have never lost anybody's money. And so I would say that we do that because, and we can claim that because we're very programmatic, we're very specific, we're very careful, and we're very conservative in how we underwrite and capitalize the investments that we make.
I cannot think of a better way to wrap up with a statement like that. Jeffrey Rosenberg, Chairman and CEO, Big V or Big Five? I should have asked
Big V, big V, big V,
that right.
big V.
Sorry.
Thank you.
So
No,
I have a classical education, so I think
and
Rome.
quick story. My grandfather opened up a supermarket. He called it Victory Markets back
Ah,
in the early 40s. He got sued because somebody else had that name, and so that's where Big V came from.
all right. Well, Chairman and CEO, Jeff Rosenberg, Chairman and CEO, Big V Property Group, thank you so much for
Thank you.
joining
Thanks for
me on the
having me.
show.
Okay, bye now.
All right, that was Jeff Rosenberg, Chairman and CEO of Big V Property Group. Jeff, what an enormous pleasure meeting you. Thanks so much for joining me today on the show. I really enjoyed our conversation. I have to tell you, your views about where interest rates are going are exactly aligned with mine. I actually remember, I know one fellow that tells me that he's been predicting a downturn for the last 10 years and underwriting to it, right? And frankly, that is the best way to play the real estate game. Assume the worst, and you will always be surprised. And uh, if not, at least you'll be safe going into the next downturn. Okay. Anyway, thanks for joining me, Jeff. And thank you too, dear viewers and listeners. Thanks so much for joining us today. I hope you got as much out of that conversation as I did. I particularly did enjoy hearing Jeff's views on where interest rates go. It's nice. It's actually very reassuring to hear people articulate the same exact views as one has, especially when it comes to predicting the future. Okay, that's it. If you've not already subscribed to my newsletter, please go to gowercrowd.com, sign up there, comes out weekly, and I have been discussing market dynamics and where I think we're headed and how to navigate the market going into 26. So you can always unsubscribe, but we do have incredibly high engagement. So something I'm doing with that newsletter is obviously right. So do go ahead and subscribe. It's totally free. You can always unsubscribe. All right, that's all I've got for you this week. Thanks again. Thanks, Jeff. Thank you for joining me. And until next week, it's Adam Gower signing off.